Conducting a sensitivity analysis in capital budgeting. Sensitivity analysis is a key tool in capital budgeting. It helps break down how changes in key inputs like sales or costs impact financial metrics like net present value and internal rate of return. Think of a company planning to build a new factory. If material costs go up, how much does that cut into profits? Sensitivity analysis isolates those risks so decision makers can plan ahead. It's about turning uncertainty into useful insight. Today we'll go over the process, the tools used, and how it applies in real-world financial risk management. The steps in sensitivity analysis. The process starts by identifying key variables that drive a project. Things like revenue, discount rates, or costs, and setting a baseline with expected values. Then you tweak one variable at a time, like increasing cost by 10%, and recalculate financial metrics like net present value or internal rate of return. This shows exactly how much each factor impacts the bottom line. For example, if labor costs go up, does the project still stay profitable? The results highlight the biggest risks so managers can focus on what really matters. It's about staying ahead of uncertainty. Quantitative tools. Sensitivity analysis relies on key financial metrics like net present value and internal rate of return to assess a project's viability. By testing different scenarios like strong sales versus a downturn, you get a clear picture of potential outcomes. Tornado diagrams are especially useful visually, ranking variables by impact, so you can see if cost risks outweigh everything else. Excel data tables are another great tool, mapping out how changes like rising fuel prices affect profitability. Imagine a delivery fleet. A data table could show how different fuel price hikes hit cash flow. These tools help turn raw numbers into clear risk signals. A practical example. This example illustrates how sensitivity analysis helps assess project risk. We'll examine a scenario where a company launches a new product and evaluates how cost increase impact net present value. The base case assumes $1 million in revenue with an initial net present value of $500,000. To test sensitivity, we analyze what happens if costs rise. As shown in the table, a 5% cost increase reduces a net present value to $425,000 at 15% drop. A 10% cost increase lowers net present value to $350,000, a 30% decline. If costs rise by 15% or more, profitability erodes significantly. This analysis highlights the importance of cost control in capital budgeting decisions. Even moderate cost increases can make an investment less attractive. Sensitivity analysis helps identify these risk points before committing to a project. Numbers alone don't tell the full story. Qualitative factors like market downturns, new regulations, or aggressive competition can disrupt projections. To adjust for uncertainty, discount rates might be increased, say 12% for riskier ventures. Sensitivity analysis isolates the impact of a single variable like cost, while scenario analysis looks at multiple factors together, such as cost and sales fluctuations. Sensitivity analysis pinpoints specific risks, while scenario analysis provides a broader view. Together, they blend data with strategy for helping businesses stay prepared for surprises.